Kia ora and welcome to Shared Lunch, brought to you by Sharesies in association with BusinessDesk. Sharesies is a wealth development platform whose purpose is to create financial empowerment for everyone. My name is Dan Brunskill. I'm the markets reporter at BusinessDesk, and we have a special offer for Sharesies investors. If you use the promo code SharedLunch100, you get $100 off an annual subscription to BusinessDesk, which is usually $249. You do the math, it's a good discount. The offer only applies to new BusinessDesk subscribers and can only be used once per subscriber and can't be used with any other discounts. All right. Before we jump into the content, here's some important information.
Investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. We also recommend reading product disclosure documents before deciding to invest. Everything you're about to see and hear is current at the time of recording.
As a reminder, if you have any questions for our guest today, you can submit them through the Ask a Question button down below. Don't put your questions in the discussion area, or you might miss them there. Put them in the Ask a Question area. And obviously, be kind and respectful towards our guest and other viewers. Otherwise, we will remove you from the webinar. Today, our guest is Felix Fok. He's a portfolio manager at Milford Asset Management. Hello, Felix.
Hello, Dan.
It's great to have you with us. Has earnings season been keeping you busy? It's sort of just ramping up here in New Zealand?
Yeah, the US goes through its earnings about a month earlier than the New Zealand market. And, by and large, it's been better than feared. So markets have been a little firmer. Yeah,
seems relatively positive. We're going to chat about the various streaming services that exist and dominate our life and culture. So it'll be exciting to jump into that. I'm not sure that they have been faring so well, but they have been enormous beneficiaries during the pandemic. So do you want to give us a little rundown on sort of the streaming boom that occurred over the past 2 years, a short history according to Felix?
Sure thing. Look, it's an exciting space. It touches, everyone's lives, right? So in essence, is entertainment, it's content that has been delivered in a very convenient manner, just over the internet, such that you can consume it on demand. You don't have to follow a certain time schedule. You can replay old shows if you so want to revisit them. And interestingly, in the case of Netflix, for example, you're also able to binge watch because you get all the episodes at once. So it's a very strong consumer proposition. And from that perspective, if you think about streaming, subscription videos on demand, as a sector, that continues to gain share in terms of time spent. So for example, in the US, in terms of watching TV broadcasts all the way to subscription videos, that share from streaming is up to about 30% of total minutes watched. And that continues to be on an upward trajectory, even now, arguably, a year or two after the initial pandemic. That trend continues to be very strong. So for the service providers, they continue to talk about more engagement, more minutes spent, and more investments in content, which hopefully, if it comes right, will then drive more subscriptions, more revenues.
And where are those consumers coming from? Are they sort of stopping watching regular TV? Are they stopping reading books? Do we have any idea where these people are coming from?
So in terms of developed markets where the concept of subscribing to a streaming provider has been running for the longest, in essence, it's been coexisting. It's been coexisting with the everyday consumptions and the distractions, if you like, of all the way from listening to music, reading books, watching normal linear television, including playing games, right? Which has been a big part of especially younger generation's cohort of how they spend their time. So it hasn't necessarily been taking things away from other forms of media, but it just has been much more convenient. The fact that you can watch a clip or a show on a mobile phone as you wait for a bus or in transit to work, it's just created an enormous amount of consumption instances.
Yeah. So obviously, we all know Netflix, the sort of the biggest player, the one who's perhaps pioneered this space a little bit. But there are now lots of players and lots of people competing in that space. Can you run us through who the big ones are? Who's challenging Netflix for the top title? Who's growing the fastest? Who are the big players?
Yeah. So based on statistics in the market in the US, which is the biggest single market and arguably the most valuable market, Netflix is up there. You have Amazon Prime Video, which encompasses something that's more than just video content. So Amazon Prime is the overarching subscription, but Prime Video is one of the perks, if you like, for being an Amazon fan. And then you have Disney, which is coming in relatively late in the game, but coming in strong now with Disney Plus, which are the core Disney franchises all the way through, including Marvel, Star Wars, and the like. But under Disney's banner, there are also live sports, which complicates the picture a little, because if people think about the topic today and think Netflix, well, that's only one sub-segment of all the content you could be consuming. So clearly Netflix doesn't do live sports, and it's often sort of left out of the conversation. But the fact that Disney is there and bundling live sports with drama shows and movies is a very formidable player. And extending that concept of what we're looking at, the universe, you also have unscripted user-generated content platforms. The likes of YouTube, for example, has for decades now timeshare has been, the amount of time being spent on social media, including YouTube, has just been phenomenal in the last decade. So arguably, there are many forms of competition, but if you're being strict about scripted drama, movies, or series drama, then it would be the Netflix, the Disney Plus, the Amazon Prime Video, the top three. But there are the whole tail of others that have been coming up.
Yeah. Yeah, it's quite interesting. We sometimes talk about this idea of the curse of success. If you come up with a business model and it works really, really well, you suddenly find other people rush to enter that space. Is that kind of what happened with Netflix? Because I don't feel like I knew much about television streaming before Netflix came along. That's kind of where I first experienced it. Did they really pioneer that space, or is that just my perception because they made Stranger Things?
Yeah, look, there's a long story about the rise of Netflix all the way from the early days when they were sending out DVDs by the post, by mail, and effectively competing against, blockbusters, those who still know what Blockbuster was, all the way from distributing second-tier, second-run content licensed from the Disneys, from the Paramount, the major studios, and then offering a way for those studios to monetize a little bit of their old library content, but also gaining a subscriber base that was a little bit indifferent as to whether they're watching the latest releases or happily to be entertained by some of the golden classics. All the way to now, in year 2022, Netflix spends $17 billion cash on, half of it on original Netflix shows and movies. So it's really come a very long way. And the reason it's able to now spend $17 billion in cash on content is because it's amassed 220 million subscribers. And that is a big enough number now to, if you like, to then make programs and have that cost of that program amortized to a very cheap cost per user.
Mm-hmm. You touch upon something interesting there in that making movies, making TV shows, particularly if they're good, is a really, really, really expensive prospect. Costs hundreds of millions to produce many of these series, which makes Netflix, some of these subscription services not outrageously cheap. And we're obviously hitting into an economic moment where people are looking to save money, dropping subscriptions. Surely that is posing some sort of challenge for these types of businesses.
So you're absolutely right. In an economic downturn, there's a whole spectrum of consumers. Some who are very fortunate are not sensitive to the cost of the service. They almost think, oh, if I factor in effectively the childcare benefit that one gets from putting a kid in front of a age-appropriate show, then it all adds up and it's good value. But then on the other end of the scale, if you're struggling to put petrol in your car, this is absolutely a discretionary category. So what we're seeing in the last year, particularly in the last year, is that the major players, Netflix has recently announced on this, Disney Plus has recently announced on this, so has Amazon Prime, they're working on layering ads into what otherwise was previously an ad-free experience. Mm-hmm. They're going to charge a lower monthly price for that version of the product, but they're definitely experimenting and stretching out the pricing tiers. So at one end, you have the premium. You can, simultaneously watch on 4 devices. You get ultra high definition quality video, and you expect to pay maybe 20, 25 bucks Kiwi per month for that. At the other end of the scale, you're going to get sort of the basic plan with ads laced in, maybe for 5 to 10 New Zealand dollars equivalent a month, in an attempt to continue to hold on to those subscribers, even if they're lower paying subscribers. Because I go back to that point, fundamentally, this is a scale game. There's a reasonably famous book in business strategy called 7 Powers, came out 2016 by Hamilton Helmer, and Netflix was a notable case study within that sort of business strategy book. And it's the prime example of this concept of scale. More subscribers you have, the lower your content cost per subscriber, as the same show can be divided into more viewers. So underlying it is like holding on to those subscribers, even if that means slightly moderating the experience by layering ads.
Mm-hmm. That's really interesting. And if you require a lot of scale to run these businesses, which it seems like it does, and there's a lot of players right now, are there too many players? Does there need to be some consolidation down the road for these to be sustainable, or can they all survive? Do you have a view on that?
I do have a view on that, and I agree with the premise of the question. There are too many players, frankly, and the issue I have at the moment is that each player, let's say the content owner, the studio is making shows and it wants to monetize that show. Each player is thinking about, can I go down what Netflix has done, which is to be exclusive, have my own direct streaming service such that I know my customers, I know the profiles, who's logging in, who's watching what, because that is the holy grail. You get extra data benefit if you're able to be direct to consumers. But the problem is not every player has enough content on its slate to be a scale player in that direct model. If you rewind the clock back to the days before streaming, most of us would have been buying a bundle from the Sky TVs or the pay TV providers of the world. And a lot of those content were effectively aggregated up into a bundle, into a pay TV, cable TV bundle. I think we're going to come full circle now. Having had the Netflixes and even some of the live sports examples going direct, a very segmented, if you like Formula One, here's what you subscribe. If you like English Premier League, this is what you pay for. Now, I think we're going to enter an era where there's just too much content for everyone to be distributing directly, exclusively. And we're probably going to come back into a bundled world, even if that bundle is now delivered over the internet with no commitments, cancel anytime.
Mm-hmm. Interesting. So you're kind of saying there that you don't expect there to be an increase in that direct consumer where Formula One, where NZ Rugby sell direct passes, and you're going to see more bundling, not less?
Yeah, I think it's going to come back to these distributors who are effectively aggregating up, because the experimental phase of the PGA golf going direct, NBA pass, it's just there is a technical aspect to it. Obviously, with distributing directly to consumers, you make sure the stream is up, and then there's the other economics of reach, right? So a lot of the streaming services we're seeing that are even for the direct ones are facing a period of heightened churn. What does that mean? It basically means if I was a subscriber last month, how likely am I to still be a subscriber next month? That rate of attrition, of loss of users who were in the business last month has increased. And for Netflix, those who follow it will know Netflix has been losing net subscribers in mature markets like the US and Canada. And that a lot of that, in my opinion, has to do with people churning out. So the larger you are as a platform, the more sensitive you are going to be to churn because you're more mature, you have more subscribers to lose.
Yeah, that's interesting. I think many of us remember the sort of shocking news. I can't remember a few weeks ago where Netflix said it had lost 1 million subscribers. And even though that was a better number than they expected to lose, kind of that million person headline kind of dominated for a while.
And just to close off the previous point, so this bundling, adding more genres, adding more content is a way to lower that churn. So that's why I was talking about that.
Yeah, so you could see, because you kind of pointed this out earlier, Disney Plus has some sport, Amazon Prime is part of a broader Amazon subscription. There's kind of more going on there than just entertainment. Could you see Netflix moving in that direction? Could it add sport? Could it add something else?
So the answer for Netflix is a bit more nuanced because that is arguably the one that has reached enough scale to be a pure play and still make it work. So at 220 million global subscribers on a business model that has up to now been largely subscription only, no ads. So any additional revenues it may get from offering an ad version of its product could potentially be cream on top. So Netflix as is profitable, cash flow wise is breaking even because it's still investing a lot of money, but accounting wise it's profitable. So it doesn't actually have to do anything so long as its subscribers continue to just edge up and not go down and not go backwards in a major way. So Netflix is in a privileged position. It's almost an exception in the context of all the other streaming players in the US which have popped up, including the likes of Paramount Plus, HBO Max. There's a whole tail there, which are likely just be too small over time to survive on its own.
Interesting. So they are the ones who have to be finding alternate revenue streams rather than Netflix per se. It's interesting to think about, some of these streamers going down the advertising route, partly in response to economic concerns. Advertising also slows down quite a lot during economic slowdowns. People are buying less things. There's no point in advertising your product if less people are buying it. You might actually be discounting your product. Is it a particularly good time even to be adding ads to the platform? And is there any idea of how much appetite there would be for advertising on streaming platforms, whether it's Netflix or other ones? Because Hulu does it already, right?
Yeah, good question. Yeah, a very good question. And there are already live examples of streaming platforms which are offering ads as well as the subscription-only ad-free situation. The likes of Hulu gets mentioned in the US. So the experience is that advertising on a subscription video platform is actually more interesting than advertising on linear television on broadcast. So if you compare against the traditional TV, then advertising on something that is streams where the profile of the person who just clicked on that video, it's better. There's more information. There's arguably a more efficient way to reach an audience. The other aspect, obviously, is the age demographics, which gets talked about. A lot of the younger generations are just not, on the terrestrial TV broadcast. So that alone, right, already means there's a value, there's an advantage to being exposed to these streaming ad inventories when they become available, when they eventually do roll out these ad-supported platforms. So far, the expectations is that, yes, there's going to be advertiser and brand interest. Even in a recession scenario, the overall ad budget may be shrinking, but the market share or the share of the wallet garnered by these relatively new inventories is probably going to be still net positive and growing fast.
This is a curveball question, but does Milford have a base case on whether or not we're going to experience a global recession or a US recession?
I think this is very much data dependent. We clearly are expecting slower growth, including the repercussions to corporate profits. So I think it's fair to say that the world is slowing. We're contending with a lot of headwinds, none of which are necessarily going to go away very soon. All the way from inflation pressures to geopolitical risk premium, Russia, Ukraine, US, China, etc. But for the very, very best companies, the blue chips in the market, they've been through crises before, and I wouldn't necessarily be overly pessimistic because ultimately, when you look at listed stock markets, quoted markets, you're dealing with the creme de la creme in those sort of economies. You're not dealing with the average business. Yeah,
interesting. Okay, talking about the creme de la creme and these top businesses, how secure is their position? It feels to me like the rise of TikTok, and we mentioned YouTube earlier. are both
Mm.
content platforms that people love and will spend hours and hours on, but they do not have to spend hundreds of millions producing their content. People just log in and make it either for free, or in the case of YouTube, there's sort of a profit sharing type thing. How big of a threat are the likes of TikTok and YouTube to the sort of traditional content creation?
It's a very good question, and I think the line is blurring. You certainly hear about key opinion leaders, those who have been very strong, effectively online celebrities that may have started out user-generated content, not particularly, a lot of production budget behind them, but getting increasingly more professional-looking content. And I think that angle is likely to be continuing. Also, fundamentally think it's neither one nor the other. You're still going to have the world of Game of Thrones, Stranger Things and the like. They always have their hold on the consumer, on the pop culture. But at the same time, you just can't underestimate the power of democratizing creativity or ability to create and then have that shared globally. I think that continues to be a phenomenal theme. But underlying it, the YouTubes, the TikToks are effectively an advertising supported stream, right? So in a way, the very fundamental business model is the same. It's about attention grabbing, how many hours, how many minutes you spend, and can you segment the viewership such that it makes even more efficient advertising.
Yeah. And I guess the other, looking at the same question in the other direction, cinemas have traditionally been, the home of movies and been big business. There's a lot of big listed cinemas. There's even a cinema software company listed here in New Zealand. People often talk about, Netflix killing the cinema. Do you think that's happening? What's the future of cinemas and sort of the movie business outside of streaming? Is it going to be okay?
I think the statistics in the US in terms of box office is that we're still about 50% below where we were in 2019. Now, you look at what some of the major releases this year, Top Gun 2 has been great. It gets a crowd back out there. But the truth of the matter is, for the cinema operators, there just hasn't been as many big titles being released. Some of these movie studios are effectively waiting for a more opportune time often to release these theatrical releases. So fundamentally, I think it's a long road to recovery for cinemas, and I'm not so sure. This one, as an investor, you wouldn't make a big call on. I think there's definitely has been a shift towards at-home entertainment for some products, some type of genre. Yeah, especially those catering towards young males. They're going to be back in the cinemas per the Top Gun 2 type comment. So there will still be some, but I think they need to focus on the experience. Obviously, the size of the cinema is an interesting dimension to think about. Right? Those cinemas who have done well, start talking about gold class experiences, and effectively, there's still going to be occasions where you want to. Maybe it's a birthday party, maybe it's a Christmas party, but you want a group of people to view the same thing at the same time, and you can't do that in the home. You don't have a big enough home, but you also expect some sort of catering additional services next to just the viewing experience. So you need to get quite creative, I think, if you're going to back a cinema business here. Mm-hmm. Interestingly, overnight in Cineworld, which is a UK listed company, they're now talking about rescue packages and needing to recapitalize with a huge amount of dilution for equity shareholders, because the thing about a cinema, you're taking a lot of square footage. There's a lot of leases, fixed costs in there, and if your bumps on seats, the occupancy isn't anywhere near 50%, then good luck. Very, very difficult business.
Yeah. You raise an interesting point there, talking about as an investor, you'd be cautious. As an investor, which of these streaming services, if any, are you invested in, or are overweight in, or underweight in? Is that something you'd be happy to share?
Yeah, happy to talk about broad strokes here. At the moment, the fund I manage is not particularly exposed to these streaming service providers. There's always indirect exposure, particularly with advertising. That as they move towards ad-supported products, there could be some impact there. But, as we've talked about, there's a lot of money chasing content. Everyone's chasing subscribers, as a knock-on effect of that. There's likely to be a consolidation phase. There's likely to be a shakeout phase coming, where, some of these content producers will give up on their attempt to directly connect with the consumers and then just license their content towards an aggregator platform. So when that day comes, the landscape will be clearer. On the other hand, think about the streaming model. Effectively, it's distribution and content creation. On the content creation side, there's arguably has been consolidation. Amazon buying MGM for $10 billion US basically took off the table the last major producing studio, with a huge library, the likes of James Bond, notably, right, is an MGM asset. And the production studio side is consolidating, which makes it net a little bit more interesting. But you still have to think about, how is it going to monetize? But I do think the content production side is consolidating, and effectively it's the bulk of the Netflix story now. Netflix started off initially as a distribution aggregator platform, showing other people's shows. Is now a lot of its fortunes in the future outlook is tied to its own show. So effectively, it's become a studio that happens to have a integrated distribution. So the production side is worth tracking, but it goes back to the same old problem with media about funding, investing in movies or drama shows. Is that how do you know that the next one will be a hit? What's your hit ratio versus the dud? Yeah. Is Netflix's data on its users' consumption patterns truly unique and net positive in terms of helping it produce the next hit show? I think that there's some arguments along those lines, but that's what the bullish angle would be.
Yeah, interesting. We should jump into listener questions because we've got quite a few coming in. The first one being, do you see Disney Plus as having a bit of an advantage in that space, as it has so much content and an incredible track record of producing hits? Does Disney Plus just kind of have a bit of a content advantage because they're so good and have so much in their stable? What do you think there?
Yes, I do think Disney Plus is advantage. There's certain IP that I think about when thinking about Disney, Marvel, Star Wars. You're trying to compare something that is, fantastical, sci-fi like superheroes with what Netflix may have, like House of Cards, the old days, Stranger Things. And at some point you say, well, they all hit shows, but who has the longer shelf life and why? And you just can't get away from the fact that Disney over the years, with a combination of, theatrical releases, cable TV shows and movies, theme parks, consumer products, have somehow created more of a feedback loop to enforce its own IP. And I think if you're, bullish Disney, that's what you believe in. But on the other hand, Disney is seeing cannibalization in its cable TV networks, including the likes of ESPN from cord cutting. So the problem with owning Disney stock, to try and express a positive view here, is that they're offset.
That's really interesting. Richard asks, how far away are we from peak streaming demand? Basically, how saturated is the total addressable market? I'd be interested to hear that both in New Zealand and maybe in developing markets, emerging markets. Oh, sorry, not New Zealand, America.
Sure. I mean, it's a definition problem. So if you think about minutes streamed per month, per quarter, I think that's still going to go up. And for us as financial investors, ultimately, it's like, it's revenues. People talk about subscribers, but, that conversation is now going to shift now because of these ad-supported versions of these products. So it's going to shift from thinking about subscriber ads to what's the revenue growth? Is it net positive? Can we go back to what's the 20% type revenue growth for Netflix, for example, down the line? So I think if you think about peak revenues, look, there's no reason to suggest we're at the ceiling or we're at the top. Globally, there's still emerging markets, markets outside of the US, Canada, UK, the traditional big English-speaking major markets that have yet to fully penetrate. So people talk about a number out there. It's like outside of China, how many households globally have pay TV subscriptions? And Netflix talked about this number and they continue to stand by it. 700 to 800 million or so already paying monthly. What's Netflix's subscriber base? 220. Well, it looks like there's still a long way to go. But the problem I have with that comparison, and I do think there's still upside here, the problem I have with that is with a streaming service, you can share it much more readily. The old pay TV subscriptions are effectively location tied, right? It's your home or the pub or wherever the premises may be. But here is a streaming service, and you have to acknowledge that people travel globally, and if they did share the passwords with their mom and dad in a different country, it's very hard to police. So the actual market may not be 700, 800 million, but it's probably still larger than 220.
Okay, so not peak saturation yet. And certainly not.
For the developed markets, it does seem like it's saturated, but globally, then no, there's more to go.
Yeah, interesting. Adam asked something we touched on earlier, we can go over again. Is there too much choice for the consumer, both in terms of choices of platforms and the amount of content being produced and not being watched, therefore not a very good return on investment? Too much choice, too much content?
Absolutely. I'm a believer in that too. And that's why I think it will re-aggregate back to what's a bundle, to the earlier point, as they're just good content there. They're trying to distribute very direct to consumer very exclusively, and they're not seeing the base, right, over which they can amortize that content. So at some point, they're going to license that content back out rather than trying to be exclusive and distribute under the brands as, streaming service. So the answer is yes, there is probably too much money chasing after content, and we need to monetize better. Some of this has to do with the impact of COVID, which has lifted production costs. And there was a moment in 2020 where a lot of these studios, streaming service included, think, oh, my release slate is getting thin because there's some of the production is getting delayed. So, it almost redoubled effort to say, oh yeah, I'm gonna approve that for production. So we arguably had a little bit of a rush order, if you like, in making content. But in general, look, I think the sign for investors to look for would be a bit more disciplined about the content spend.
Yeah, it's really interesting that it's hard to pick apart how this market might have developed or what shows might be being produced or the cost of them involved. If it weren't for the pandemic, the rise of streaming and the pandemic have sort of happened at once and created some mixed signals. We've got a question from Colin, which says, Apple TV seems to provide the streaming service for free when you buy their products or bundled in other services. So it doesn't need to make money or as much money. Do you see that as a major threat to Netflix that obviously needs to be extracting money directly from these people directly?
Yeah, so I put Apple and Amazon in that camp where they have existing businesses and they don't necessarily need to make money off that subscription service, specifically video subscription. So they both are very large companies, So if you think about the market cap of Netflix, I just checked, it's 100 billion. Apple is closing in pretty close to like 2 trillion. Amazon, 1.5 in that order, in that ballpark. It's night and day, and they clearly can't go toe to toe necessarily if Apple and Amazon truly put their mind on tackling and giving it the attention that a Netflix would, right? Because that's the only business they have. So yes, absolutely, it's a threat. The bundles at Apple and Amazon are likely to grow. They're going to add games. They already have added games. They're going to add live sports. That's already coming. Again, go back to this full on, I just want to be entertained. I don't necessarily care which show I watch. Then those bundles become a lot more attractive. Whereas, if you're a fan of the IP, be it Stranger Things or any of the other Netflix IPs, then you're going to be specific. So the question is, can the IP be so distinctive and so drawing that it keeps the subscribers, for a pure play like Netflix?
That's really interesting. It's been interesting also watching Apple, talk about market saturation. They're sort of reaching a point where they've sold a lot of iPhones and they've sold a lot of MacBooks, and they're kind of, after being a hardware company forever, they're kind of reaching hardware saturation, arguably, and they're sort of putting a lot more emphasis on their various services, whether it's like a buy now, pay later service, cloud storage service. And you could imagine them putting more emphasis on their streaming service, since they're sort of reaching some sort of saturation level with their hardware.
Absolutely.
Last question we have here is, I hope you can't hear that siren too loudly. It's very loud in my office. Apologies. Given the saturation of the market and the amount of churn, do you see any potential for having a pay-per-view model, perhaps pay for a series? We talked about paying for sports, and are there any platforms that are well placed to do that?
There are platforms. In effect, it's sort of the days before the streaming subscription services, right? Where you go into an iTunes and you could just buy per episode within a series, or buy a movie. I do think just speaking from personal experience here, I do find some, attractiveness with going back to that mode. So as financial investors, we are all looking for effectively a long duration of cash flows, right? A stream of cash flows that hopefully can grow over time. And as a consumer, the flip side of this is I don't want to be paying a stream of cash flows out that grows over time for the service provider, right? So if I know what I like, and I'm thinking about the library here, like I'm a Matrix fan. I bought all 3 or 4, right, of the installments of the Matrix, and I know every now and again I'll go back to them. Surely it's much cheaper, purely on that consumption basis, for me to just buy the digital rights of the Matrix on iTunes and have them hold a copy, and I just effectively be streaming it when I want to watch it, then continue to pay $15-20 for the rest of my life, right? So I do actually think, but you have to be very conscious as a consumer to make that choice, right? Because one of the ways that the streaming services will get you is this auto renewal, right? So unless you are really thinking about what's my optimal position on any particular consumption aspect, you're not necessarily, the entire subscriber base is a continuum of very conscious people to those who just want to be entertained, right? So that there's going to be some people who would give value to just buying a la carte, as they call it in the industry, or piecemeal.
Yeah, I must admit that's what I do. I tend to go and rent or buy a movie from Apple or from YouTube, in fact, and then I just watch the movie I want to watch, and then I move on with my life. But doesn't seem to be the most popular model. All right, well, that's sort of all we have time for. But thank you everyone for tuning in, and a massive thanks to Felix for joining us. We really appreciate having your time and your insight.
No, good to be here, Dan.
Pleasure. Next week on Shared Lunch, our guest is Julie Hodson, the CEO of Spark. I'm sure there'll be a lot of interesting things to talk about there, including streaming, which they had a bit of a go at, and I don't know. I'll let her say how it goes. A link to register for that discussion is in the chat right now. Until next time, enjoy the rest of your week and stay safe. Thank you again.